July 31st, 2025. Figma goes public. The hype is deafening. The stock opens at $33, rips to $115 on day one, and eventually peaks at $142. Everyone wanted a piece of the AI design monopoly. Fast forward 6 months. The party isn't just over. The police have arrived. Figma has crashed 82% from its highs, trading today at roughly $26. The headlines are screaming about a billion-dollar loss, and investors are terrified of the lockup expiration. So did the business break, or did the bubble just burst? Today, we are doing a fundamental deep dive into Figma. We're going to tear apart the Q3 earnings, audit the cash flow reality, and model the valuation to answer one question. Is Figma a value trap or the single best buying opportunity in SaaS today? Let's get to work. If you are new to this channel, welcome. This is Joe from the Investment Diary. I have been investing for the past more than 5 years and have consistently beat the market in the past 3 years with more than 20% annualized returns. I have traded Forex, commodities, stocks, and options, made painful mistakes and punished by the market, and I would like to share my lessons and journey of investing with you in this channel so we can both supercharge our investments. Support me by tapping on the like and subscribe buttons. First, we need to understand the anatomy of this crash. An 82% drawdown usually signals bankruptcy or fraud. With Figma, it signals a return to reality. The stock peaked at $142.92. At that price, investors were paying over 60 times sales. That is not investing, that is gambling. The drop to $26 has simply reset the valuation to roughly 12 times forward sales. Painful for bag holders? Yes. Attractive for new money? We'll see. Now, let's address the elephant in the room. You probably saw the headline, Figma loses $1.1 billion in Q3. If you sold because of that headline, you made a mistake. That loss was almost entirely artificial. It included $975.7 million in one-time stock-based compensation, or SBC, triggered by the IPO. This is an accounting event, not a cash-burning event. When you strip that out, the underlying business engine is fine. But there is a real reason the stock is weak right now, and it has to do with who owns the shares. We'll cover the lockup situation in Part 3. Before we look at the spreadsheet, we have to look at the product. Why does Figma win? It's not because it's a better drawing tool, it's because it's multiplayer. In the old days, you emailed a file. In Figma, you send a link. Once a designer sends a link to a product manager or a developer, that person must use Figma to see the specs. The network effect is brutal for competitors. The proof is in the metric. Net dollar retention, or NDR, is 131% for their large customers. That means if Figma didn't sign a single new client this year, they would still grow revenue by 31% just from existing customers buying more seats. That is elite, top decile in the software world. And regarding the Adobe risk, remember, Adobe tried to buy them for $20 billion and failed. That deal falling through was a blessing. It forced Figma to stay independent, launch dev mode, and keep the upside for shareholders, not Adobe's. Now, let's look under the hood. I use a 3-pillar checklist to verify if a company is healthy. Pillar 1, revenue growth. In fiscal year 2024, they did $749 million, up 48%. In Q3 of 2025, they did $274 million, up 38%. Guidance for the full year 2025 is roughly $1.045 billion. Verdict? Pass. Growing nearly 40% at a billion-dollar scale is rare. This is organic, product-led growth. Pillar 2, free cash flow. This is where it gets nuanced. In Q2, they posted a 24% free cash flow margin. In Q3, that dipped to 18%, $49 million. Is this bad? Not necessarily. Margins often fluctuate around an IPO due to increased operational costs, but an 18% margin is still positive. They are printing cash, not burning it. As an investor, I want to see this climb back above 20% in the next 2 quarters. If it drops to single digits, we have a problem. For now, pass. Pillar 3, the rule of 40. You add growth rate, 38%, plus free cash flow margin, 18%. That gives Figma a score of 56. Anything above 40 is excellent. Figma is growing efficiently. Okay, pay attention. This is the most important part of the video. Why is the stock stuck at $26 despite good numbers? It's the lockup. Figma's IPO lockup expired on January 27, 2026. This allowed employees and early investors to finally sell their shares. That event created a mechanical wave of selling that crushed the stock price in January. Here is the nuance. The worst mechanical shock is likely behind us. The big eligibility event was January 27th. However, selling isn't over. Figma has an extended lockup agreement for major shareholders. These shares unlock in phases, staged releases, tied to future earnings reports throughout 2026. This means we won't see one giant crash, but we will see a steady supply of shares hitting the market. For the stock price to go up, demand from investors like you and me has to exceed this supply. The takeaway? The story has shifted. It's no longer about IPO mechanics, it's now a battle between fundamentals and supply absorption. If Figma keeps growing at 30% plus, the market will absorb those shares. So, what is it worth? Let's run the discounted cash flow. I'm assuming revenue hits $1.045 billion this year. I'm fading growth conservatively to 30% over the next few years. I'm normalizing free cash flow margins to 25%. Based on these numbers, here are my price targets. The bear case, growth slows to 20%, margins stick at 15%, the stock could drift down to $20. But honestly, at $20, the downside feels limited. The base case, /fair value, the supply gets absorbed and the market rewards the 30% growth. My fair value is between $38 and $42. That represents roughly 50% upside from today's price of roughly $26. The bull case, AI monetization explodes, margins hit 30%. We could see $60 plus in the next 18 months. To wrap this up, Figma is a classic IPO hangover. The tourists who bought the hype at $140 are gone. The lockup panic is playing out. What's left is a monopoly-style business growing at 40%, printing cash, trading at a reasonable 12x sales. My verdict? Accumulate. I am buying this dip. It will be volatile, but the risk-reward is finally in our favor. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for today's video. See you in my next diary.